My biggest trading breakthrough came when I stopped being a trader and started to run the business of trading. It's a different perspective and a different skill set to have, but less in the execution, less looking at charts, less doing the stuff, and more running the background stuff. That's basically the best way to describe what I do. And in today's video, I'm going to break down a portfolio that I've just created over the last week or two. I'm going to show you how it works and the benefits of having a diversified approach to algo trading. So if you read any of the books by the big Wall Street legends, people like Ray Dalio, Peter Lynch, even Warren Buffett to a certain degree, they always talk about diversity as the key to their success, or one of the keys to their successes. In the trading space, very few people actually diversify. Most people have one or two strategies on one or two instruments, but that's not true diversity. And when you're trading manually, it's very, very hard to trade with a diversified approach because there's so many things going on. You have work obligations, family obligations, and to look at that many things and concentrate, it's very challenging. But when you have an automated portfolio, it's different. So I'm going to break down an example right now. So if we look at this chart right now, and you can see these strategies. This is from 2018 to current day. This is just the back test data. This is one of the very first steps that we do is the back test data. And you can see the individual strategies, how they performed. There's some drawdown period, and it looks okay. I mean, it's sloping up to the right. It's not great, but it shows a typical individual strategies on one of the portfolios. Now, if we head into how the portfolio looks, you can see it's a much smoother and linear equity curves, and the drawdowns aren't as significant because when you're trading a portfolio-based approach, you may have 10 assets and 3 may be in drawdown and 3 may be in profit, which cancel each other out. Whereas if you were trading manually and you weren't diversified, those 3 in drawdown, you're in drawdown. So here's one of the portfolios that I'm going to start running this week, and it's compromised pretty much from indexes. I like to trade indexes more than anything else, whether you're trading futures or whether you're trading it through a CFD format or through a Forex broker. I just much prefer the feel of indexes. They're smoother, they're not as erratic. That's me. So let's just break down what's going on here. First and foremost, ignore this number. There's a little error here. But if we look at the actual, let me see if I can actually increase this. I can't increase the size. So if we look at the actual performance of this trade, it took 2,000 trades with a profit factor of 2.2, which is decent. Winning percentage of 57% win rate, which is round about my norm. It did go into a little bit more drawdown than I'm comfortable with in 2020 because of COVID. Or 21, whatever it was. So it went into 10% drawdown, but a lot of people lost their accounts during that stage. But you can see some stats here that are important. The average open drawdown, the R expectancy is decent. The average profit compared to the loss, everything that you'd expect on a good performing strategy. And the actual winning months is significant too. There are very, very few red months throughout this entire period. So that's an overview of the strategy. If we actually see the list of trades, it's pretty normal. You go through periods of wins and losses like any trading strategy, and it's normal. One thing that people don't understand, just because you're trading algorithmically, it doesn't mean that you don't go into losses. Like you can see here, just at the start of 2017, 1, 2, 3, 4, 5, 6 losses in a row. But then he went on a string of 12, 13 winners in a row. So that's like a normal portfolio. That's what a normal portfolio looks like. And these are all the positions the strategy, the portfolio as a whole ever took. If we head over to the equity chart, which I've already been, one thing I do like about this portfolio that I'm about to run is the stagnation is super low. Now the stagnation basically means from the peak to a little bit of drawdown, how long did it take to recover? Most strategies that I run are over 100 days. For a portfolio-based approach, this one is only 73 days, so that's really, really good. If we look at the analysis on this actual portfolio, where are we? Let's choose a different one, actually. Here we go. So the next thing you want to look at when you're creating a portfolio is the correlation. So you have all of these different strategies on different assets. And the drawback to trading a portfolio-based approach is you could experience some heightened exposure. You could be in too many open positions, which you could, especially for trading prop firms, that could lead to an increase in open equity drawdown or to even breach the rules. So we run something called a correlation matrix, which basically combines all the strategies and looks throughout history to see when they had profit and loss, return to drawdown, open position correlation, equity positions. So you can see anything in this light green is lowly correlated, which means basically not everything's taking the same positions at the same time or same losses at the same time. That's super important because we don't want huge amounts of exposure. So that's basically the overview of how to trade algorithmically. That's an overview of how to remove yourself from the equation and run the business of trading. And to build this whole process, I didn't have to learn how to code. I didn't have to do any of that sort of stuff. The skill set here is data analysis. That's the real skill set when you're running the business of trading. And when this is live in my account, as of next week, this is a bit of a more aggressive than I'm used to, but when this is live in my account, it'll very much be hands-off. So I'll update on the progress of this, but this is running the business of trading and less being a trader.